Good morning, everyone. My name is Matt Tepper. I am the Director of Global Marketing here at GDS Link and want to welcome you to today's webinar. The current economic uncertainty is putting organizations under immense pressure, and many lenders are tightening cutoffs to manage this additional risk. But this knee-jerk reaction can ultimately cause the cost to acquire good loans to soar while new defaults increase and shrink profits even further. Today, we will see the results from real clients' analytics solutions, as well as a walkthrough of the custom models and integrations that were used to gather from GDS Link's repository of hundreds of data sources. Through advanced analytics techniques showcased today, GDS Link Modelica Analytics has been able to help our clients maintain a competitive advantage, keeping costs down and managing the additional risk despite cost of funds increasing, loss concerns rising, and declines driving down their bottom line. But before we get started, just a bit of housekeeping. If you have any questions during the presentation, please type them into the Q&A box in your Zoom control panel. In the interest of time and getting everyone in and out in a reasonable manner, we will address questions towards the end of the presentation. This slide deck will be emailed out to all attendees later today, and the webinar is being recorded and will be available for replay through our website, gdslink.com, as well as our social media channels. If you have not done so already, I would encourage you all to follow us on Facebook, LinkedIn, and Twitter, where you can stay up to date on the latest industry trends, as well as GDS Link's latest offerings, including our latest blog around developing a collection strategy to improve your loan portfolio performance. Also, be sure to check out GDS Link's own podcast, The Lending Link, hosted by GDS Link's Executive Vice President of Business Development and Partnerships, Rich Alterman. In each episode, Rich meets with a wide range of guests across the financial services spectrum to gain insights from the worlds of fintech, banking, technology, and everything in between. We recently just launched 2 new episodes, including discussions with Tom O'Neill, a risk consultant with Equifax, as well as Frank Tien, the author of Unsecured Risk Management, A Practitioner's Guide. All episodes of The Lending Link are available via all listening platforms, including Apple Podcasts, Spotify, and Google Podcasts, among others. Now, without further ado, I want to introduce our panelists for today's discussion. Carl Spilker is the Executive Vice President of Global Analytics and Advisory here at GDS Link. Carl is an accomplished executive with global experience has held senior leadership roles for companies such as Easy Corp, Dollar Financial Group, Lloyd's TSB, GE, and Experian. Carl possesses a proven executive management track record and over 20 years experience delivering consumer lending products offline and online, utilizing complex analytical instruments such as artificial intelligence, machine learning, and traditional multivariate models, and has experience in small business portfolio management. Welcome, Carl. Also joining us today is Nathan Petrie, GDS Link's Analytics Account Executive. Nate joined the GDS team after nearly a decade of experience within Equifax, starting as an operations analyst before ultimately assisting in the development of their credit scoring team, where he was responsible for both project delivery for hundreds of Equifax clients, but also mining of internal and external data for eventual integration into these projects. Welcome, Nate. Anything I might have missed?
No, great to be here. Thank you.
Well, guys, we'll go ahead and jump into it. It's hard to tell what you can really trust these days with so many variables yielding what seems to be contradicting information, with a prime example exemplified in TransUnion's latest consumer credit report. TU's Vantage score has seen a substantial rise in just since 3-4 years ago. While it has been well documented that stimulus payments were widely used to help pay down debt obligations, which subsequently led to line increases for many consumers, the performance and credit score does not seem to accurately reflect the rising delinquency rates we saw towards the end of last year. This could indicate that while people's credit scores may be improving, they're struggling to make their loan payments on time. We can also see that personal savings rates are on the decline. This means that people are relying less on their own savings and perhaps more on borrowing to make ends meet. So what does that mean for lending organizations? Just relying on credit scores may not give the full picture of a customer's financial situation. It's important to consider other factors such as income and savings in order to make informed lending decisions. But again, you guys are a little bit more of the subject matter experts. Do you have any thoughts on this, Nate?
Yeah, I think, if you think about the last recession or going back even further, the prior recessions, one of the important areas to tie in here is the fact that credit scores, traditional credit models and credit scores broke down and really didn't effectively rank order risk through those downturns. And a lot of that, we had some learnings from the last time around. So they may have improved some of those scores. But I think what they're missing is really they're only able to look at what is reported to them. So if you don't have the full picture and you don't sort of have some of the variables on cash flow, I think is one important area. You might not capture some of those signals in the traditional credit bureau data. And when you see things like the average score still on the rise while delinquencies are trickling up, it sort of makes me wonder if that cash flow data being missing from there is really only giving you an incorrect view of what to, sort of what to expect from a default perspective. You would expect that the credit scores would start to go down as those defaults go up, but we're not seeing that. And then we also see, more consumers are extending themselves with other products that maybe are not reported to credit reporting agencies. So you see a lot more pay in for type organizations that are really doing well in the industry and getting a lot of customers to use their products. And so that information, I think, is part of the reason why we see stability in some of these metrics. You see with the scores, but you see, deposits are going down. What is that really going to mean down the road as we start to extend ourselves as consumers with more credit, more debt?
So perhaps looking at some of this historical data, I assume this could probably provide some insights as to how lenders should proceed for the next few months.
Yeah, and so just to kind of give you a heads up what we're looking at here. So this is from Equifax, a small business database. And there's a couple things to point out. At the top here, you have all of the originations by year in their database. And then on the y-axis, you have the score tranches. So for example, in the 640 to 659, if an obligation originated in 2004, those carried a 6.1% probability default. A borrower scoring with the same score that originated in 2007, that default rate was just about double for the next 2 years on those obligations. So, I think there's a couple things to point out. I mentioned that credit scores typically didn't rank order very well through the recession. This score was built post-recession, so there might be part of the reason why it worked so well on that last recession, because it did have all those learnings baked in there. But I think it demonstrates really well how default rates shift over the years, and how, sort of keeping your process static as we think about, are we coming into a recession? Is that really the most effective approach? So there's a few things, like I said, that, a good score should rank order even through a recession. And in this case here, if you wanted to, as a lender, if you were trying to manage your risk, I think the most obvious would be in that scenario where if you had a 650 score, right, averaging about a 6.1% probability default, and that was your cutoff that you were using in your organization, a 20-point increase could keep your default rates flat. So say you picked up on some of the early term delinquency in 06, 07, you're not going to save the ones that were already booked, but you can adjust and really manage to that risk that you expect coming forward. This, I think, is still better than what we saw the last time around. So thinking about adjusting cutoffs and being able to effectively manage, if you have a good score that's rank ordering, you can make those adjustments and still have the positive impact. But if the scores that are underlying in your process are really not working, it's not going to help you to adjust cutoffs, because those defaults might still come in the higher tiers. So going back to my original point, I think a good model should always rank order even during a downturn. But the storm is going to have different components every time it comes around. So do they still work if you go off of what you've learned the last time? And this is where I think you tie in monitoring of your models really as a key to the organization's ability to ride that wave and stay ahead of defaults. So as new performance data is fed into your system, we have Medelica Pro, which our lenders are using to do this monitoring. The model's ability to take that information on the fly and predict and quickly relay those predictions to a credit team and data scientists, they're able to make those changes quickly, and ideally they're going to avoid some of that loss that would have come through the door had they kept things static. I also believe that the cash flow is important to hedging loss. So in lieu of financial statements, which are not going to work, they really don't have a place in automated systems. We've seen through some of the projects that we've done, and I think Carl will demonstrate some of this, about a 15% lift in models that include open banking data versus just traditional credit reporting agency information. And I think that's really what's going to help some of these lenders hedge through any recessions, is sort of taking in a 360-degree view of your borrower and not just focusing in on the credit bureau attributes or credit bureau data that you might be consuming today.
Yeah, it's interesting to hear you kind of talk about the utility of some of this open banking data and doing a little bit of research and kind of compiling information for today's session. Obviously, I think everyone's well aware that originations are down or starting to flatten a little bit just due to the economic climate, but there's still some opportunities out there in the form of new to credit consumers. And I certainly identify that it might be a challenge to navigate decision-making against borrowers with little to no credit file, but it does seem that these NTC consumers generally perform as well or even better than more established consumers with a similar risk score. And from all indications, they've identified that their borrowing needs are only going to increase for the next few years. And one of the highlights from TransUnion's quarterly report was that it's imperative for lenders to build these relationships with these new to credit consumers. Obviously, having that first foot in the door can help establish loyalty to the institutions that were the first ones to offer them some of these credit products. Carl, I know that you and your team have a wealth of experience in helping our clients effectively integrate open banking as well as other alternative data into their decision-making processes. Was thought that you might be able to touch on some of the value that these type of attributes can provide.
Yeah, absolutely. Thank you, Matt. I'm going to cover kind of a broad range of some topics, but one of the things we've been fortunate is digging into what we'll call the alternative type of data. And one of the things we jumped into 3 years ago inside of GDS was the open banking and bank transaction data and how that helps introduce incremental value to the decisioning. And one of the things that we're finding is there's credit data across all three of the major bureaus. The lion's share of clients are leveraging that. Then there's a search for alternative data. And the thing that we found quite interesting is we can take this open banking and expose it and create thousands of attributes and help it inform models. During this COVID period, one of the interesting things is it felt like the Bureau went on a bit of a 6-month freeze. There wasn't a lot of activity. A lot of customers were pretty flush with cash. And so open banking helped fill that void as far as cash flow and verifying that there's consistent income coming into the account. And I'll speak a little bit towards the end about some of the case studies at a very high level that we saw from this type of data. So two of the things that we think about, obviously, is data. So there's things about building models. So I sort of view the information as a bit of the wood that feeds the fire. And the fire is controlled by how well you build these models. The benefit we have inside of GDS is one of our normalized credit attributes products. So any of the bureaus that you may be pulling, Experian, Equifax, TransUnion, will be able to provide and introduce you a normalized set of 6,000 plus attributes. We can collapse them if there's even a cosigner into the event. And what it allows you to do is for some clients that may want to shift from one provider to the other, It minimizes that switching cost. And for others, when you want to do a tertiary or a secondary pull, it again helps normalize that process. And we do offer great value in that. We'd love to talk with folks who'd be interested in licensing that service from us. The other one is the open banking piece. Again, agnostic to provider, much broader, what do you call it? Much broader reach across the US. So any provider such as a Yodlee, Plaid, Rivet.ai, MX, Direct ID, for example, we'll be able to create these consistent attributes. So I'll chat a little bit about why that's important, because it helps us introduce it into our modeling, gains more cash flow, more recency, and more trajectory of how income's coming into accounts, etc. Nate, you're open to step in and contribute if I've missed a couple of things, but the piece that we like to do with a lot of this is we've got a tremendous wealth of model development experience. We've also built a way to stabilize and create a repeat proof model monitoring service. So what we did is we offered a service, we'll call it Modelica Analytics. And really what that was, it's to leverage our industry experts. We've got PhDs, significant hands-on modeling expertise across the globe. We know the data, that's the GDS software and software solution. And we build the models for fairly good introductory cost. And then part of our ongoing values prop is that we do the ongoing model monitoring, which means we're providing population stability reporting, ongoing validation that the models are tracking to the performance that we built or you built it on. And the other thing we took away is the worry about this being GDS IP. It's your IP, you pay for the solution, license the service, you get that. And as portfolios shift and change, we step up, we do the retuning or full-on rebuild of your models and can deploy them in our environment or deploy them in your own environment on your own solution.
One thing to really quickly add in there, if you think about the definition of model might be different to some folks. So when we're talking about model here, really talking about, building out custom scores. But in addition to that, this data and a model might mean to you, including your rack or your rule set. And I think one of the areas where this data is helpful as well is in setting appropriate rules using this information. There's things like gambling triggers where, if you're an organization that wants to avoid somebody with a gambling problem, really there's not many ways to see that, but the open banking helps illuminate some of those types of features that I think are missing from some of the traditional data sources, and maybe give you a little bit of a safety net for some bad actors.
Thanks, Nathan. And the other piece too is just discovering some new insights. So one of the things that people have got their own analytics shop, that's fantastic. We can kind of step in and be a bit of a augmentation and maybe add a different perspective. For those that don't have their own analytics shops and infrastructures, the piece is we actually walk you through that. So you'll learn with us as we're running the various variables through the model. It's very we'll call it transparent and open process. As I mentioned, the ownership is yours. You get a mini credit committee pack review of the data each month, ensure that the models are performing at the top performance that we originally built those in. So,
yeah, which leads into our main showcase today. I know that Carl, Nate, you guys wanted to walk through a couple of use cases of the work that we provided for some of our clients.
Perfect. If you'll go to the next page, we'll talk about so we found over the last 3 years, we've built hundreds of various models. We don't just stick with the AI machine learning framework. We also leverage traditional logistic regressions and other techniques, genetic algorithms, et cetera, et cetera. But one of the pieces that we find that we can add is our GDS credit attributes are able to contribute value. And as I said, it kind of normalizes things. And so what I try to do is I try to break out where does the value come from? Data, or is the value coming from the model build itself? Typically, and I'll give you an example in one of these scenarios, is a client had a very limited variable set that they had been working with. And so by exploding that parameter space, leveraging our GDS attributes, we were able to provide significantly more lift with the models. So creating more inputs that form the model generated tremendous value for these particular clients. And in this case, we saw a fairly sizable reduction in first paid, never paid defaults. And then I would kind of weigh them towards fraud and then also towards more of your default risk. The other side was there's a dramatic swap in universe that came in. We step into another scenario where somebody has rich credit data provided by one of the three bureaus I mentioned earlier. Introducing the open banking data, again, kind of help explode new insights. As you'll see, this loan segment is on the other end of what I'll call the prime subprime space. And what they gained was dramatic lift. So that open banking data really helped tease out and separate the risk in those higher risk, where they were able to swap in and swap out a good chunk of losses. I want to touch on a prime candidates that I actually do not have in this scenario. But we had a prime candidate that when we started validating, leveraging some of the open banking features, you'd think it would help really down on the low risk side of the scoring spectrum. But what it did is it drove lift across the whole gains chart, lift chart, if you're familiar with that terminology. With these clients, when they're lending above $10,000, kind of getting that swap in from a 3 to 5% loss rate and a swap out, leveraging better data and better modeling, definitely drove incremental profitable value. And for them, it's, of the tune of about $1.2 million per month. So as you can kind of see, there's really two things. A lot of it's to do with the models. A lot of it's to do with expanding that parameter space with these new features to drive new insights and lift to their model performance. Let's touch on the next page on small businesses. Did we, just a quick question, Matt, did we have a space here where people could fire in some questions, et cetera?
Yes, if folks are
Okay.
able to submit questions via the Q&A button at the bottom of your control panel. If you guys do have questions, feel free to get those to us. Was hoping to cover those probably towards the end of the conversation.
Perfect. I just wanted to take a pause and spend a few minutes. There's another alternative group in the small business space. And it's an interesting world because there's a tremendous amount of automated processes. And when I think of automation, it's Carl Spilker asking for detail from the applicant and other clients. There's a second piece that automating is how can I get that detail to the underwriter more quickly and efficiently? And then there's a new added phase to that automation is how can I get that detail to that underwriter and have a more complete picture of the customer's risk profile. Many of our small business lenders will lend in an automated way, live, real time, within seconds for less than 10 grand, for example. But as you're bumping up to the 25, 50, 75,000, there's still a couple of things that need to be done. That's a bit more of a manual process. So the thing that's been popping out is our ability to take the open banking, and there's two scenarios. There's a live call, direct integration to your client that allows you to sign on, and we could scoop that JSON and create thousands of features and place it into an Excel or PDF, or just present those features for you to embed into your environment. Or there's the other piece where you use an OCR provider, Ocrolus, MoneyThumb, for example. And we can, again, take that data they consume from a PDF and convert to a JSON and automatically produce that suite of attributes, scores, and or dashboards that I'd mentioned, an Excel format summarizing monthly, weekly spend, type of spend, etc.
If I could add too, for the small business, sorry, Carl, didn't mean to cut you off there. I think for the small business space, one of the major areas of concern that I've heard over my tenure is hit rates. So, there's a few data providers out there from a more standard credit bureau perspective, but the data is fairly limited when you do get a hit back. And, you think about average hit rates are probably somewhere around 75% if you're lucky. If you're doing more higher risk borrowers or startups, sole proprietors, that can be significantly less. And a lot of people today, they might be taking something like an SBSS score, which is really just a rebranded consumer score, or they're just using consumer data to drive that process, especially on the smaller obligations. But I think when you take in open banking data, all businesses have a checking account, you would assume. And it's really up to them if they want the obligation and there's limited data. Would you rather ask for full financial statements, or is it more efficient and just as appropriate, or from a risk perspective, gives you the similar lift to use a connector and pull in attributes and automatically parse those out in your system and in your process? So I think that helps close some of the data gaps that are very prevalent in the small business side. I'll give it back to you, Carl. Thanks.
Thanks. I'm chatting into the mute button. That's a gift of mine. Yeah. So the other piece too is, now that we've been able to expose this, one of the things that a lot of the small business lenders received was, instead of days to respond, they were able to respond with a pricing and a limit within minutes, if not hours. So that helped expedite what I'll call the close to funded ratio, which really drove good value to clients. The modeling techniques, in many cases, people aren't leveraging things, and it's probably taken them a while to build up some history of loss. And we've been very fortunate to be able to drive out some inefficient loss performance and profile and help clients kind of understand why that's the case. Another one is automating, which is speeding up the processes, which is taking less manual hours and freeing up a pretty sizable chunk in this other category of other operational expenses. And that's been a big win for quite a few of our clients. So I'll pause to that one, and we'll take a break for some questions.
So one question that we've gotten so far, and it kind of speaks to some of the things that you're presenting here, Carl, is on our previous slide, we kind of spoke a little bit about GDS's credit attributes. And on the slide itself, we actually promoted our white paper around how the GDS Link attributes are yielding equal accuracy to that of the big three. First off, we'll make sure that in the follow-up email following this, that we will provide a link where everyone can access that report. But Carl, it looks like the question was if you can maybe provide a little more color or context around how we were able to determine, how it was determined that we're yielding the same equal accuracy.
For each of the models?
Yes.
So that's one of the things, and I'll wax a little bit philosophically. way I view is the model that we would ultimately likely build off a client's base has a AUC, ROC type measure, KS, and there's lift charts and things that you're measuring. There's also what I call simply kind of the gains distribution, which is letting you know the lowest risk is a 1%, the marginal is a 10, and the folks you're cutting off is a 15% loss rate. As you're moving forward, you want to know that that model is going to model, or that model is going to predict at those loss rates once you obtain enough performance. So the challenge is we leverage the variables feeding the model to ensure they're stable and they're consistent. And the implication there is that the variables, the following months and the following months are stable, meeting statistical relevance, and they're not unstable, that your model is going to predict those rates. We then start looking at some early default indicators. So part of that monthly review is that if a 1% had an X% 30-day and an X% 60, and then an X% 90-day, that equals a charge off, for example, and it's tracking to that, and all the variables are stable in the model, then the outcome typically is that your model is going to perform exactly as you designed it. Why this is important is you are doing a lot of strategic things leveraging that score, such as pricing. You're leveraging it for how you're assigning line limits. And so just knowing that your cutoff is eliminating more than 50% dollar losses, you want to know that each and every one of those intervals is driving that prediction. So there's a whole suite of variables that we will be tracking to that ultimate validation. And where we all win as a business for GDS and as you, the client, is that AUC of 70 tracks to an AUC of 70 on the validation. And those loss rates are tracking to what we had predicted with the original development data set. And where there may be shift in the curves, that's where we'll step in, do a retune. And if we can't retune it efficiently, a full-on rebuild to get you back to those expectations.
Carl, when you're building out a new model, what, from a data sufficiency perspective, what are you kind of looking for? Is there a minimum number of defaults or a number of applications that you would say would be sufficient? And how would you approach, sort of that side of it?
That's a great question, Nathan, because it does pop up. Really having 300 bad events is the bare minimum, which makes the model a little more difficult to build. At the 500 plus bads, then you're in a unique state that you feel the model can be pretty stable, subtly predictive. Anything less than 300, it's quite an unstable environment.
Another question that
300 bads, not applications.
Right.
Another question that has popped up is, can you kind of speak to maybe an instance where maybe through monitoring the models that are in place that Modelica Pro has possibly caught an issue for a consumer and maybe be able to kind of glean on that a little bit?
Yeah, one example was I'm just traditionally, I like to focus on what I call a bit of the fraud profile. And fraud is either ideally someone that has done something fraudulently, it's been verified, but in many cases, many institutions aren't quite aware of that. So I look at what I'll call the never pay trigger. And with this happened with 3 different clients where they felt that fraud wasn't really a challenge. As we start digging into it, we do find that there's a fairly sizable chunk of people coming in, applying. They've passed all their IDV, other checks, and just walked away, never paid. And it was a fairly expensive chunk of their business that just consistently came in every month. And that was an eye opener for these 3 various clients to realize that they'd been absorbing these type of losses. So we kind of tuned our fraud model to tease out those never pay, and then those that survived that cutoff flowed into a default model that looked for more aging default, so you could deal with, just random events of missed pays, not taking a payday, or making the loan on time, and just getting more towards a true aging default. So those are three cases, and some of them were absorbing two, another one up to $1 million in losses in this scenario I described. A recent thing is just you go through and you create your 10 variables for the models. Everything's swimmingly going well, to find out at time of deployment there's something corrupt with one of the features, or they just decided there's a reason why they don't need to put that in. Or in some cases, that feature is not what they had originally thought it was. And so that was kind of a unique case. So they have to go back and kind of clean up their own infrastructure. We replace those variables with something as predicted. A bit of a data hygiene exercise comes out of this as well.
Thank you for that. If anyone has any additional questions, again, the Q&A button at the bottom of your control panel is where you can go ahead and submit those. Switching gears a little bit and kind of speaking to just the resources at our disposal here as a GDS here at GDS Link is we're happy to announce the recent integration with Equifax's Ignite platform. Nate, I know that you might be a little bit more familiar with really the power that this kind of will bring to GDS as well for our analytics offering. Want to see if maybe you just had a couple of thoughts around really some of the value this will be driving.
Yeah, I think, if you're looking to utilize credit data in a model building exercise, it can be somewhat unattainable. And for companies like Equifax and others that do offer analytic sandboxes to play in, they're typically for the largest enterprise level organizations. So through our team, thinking about the question on data sufficiency, how many bads do you need to build an effective model? The answer that Carl gave is sort of the minimum, but the other side of it is really the more data that you have, the better you can model off of. And having access to something like Ignite enables our team to mine specific types of borrowers that maybe match or mirror the complexion of the borrowers that our lenders are looking at. And it allows them to test across larger data sets and make changes and see how those changes would impact the portfolio and not have to go to the bureau directly and try to get a flat file or gain access or credentials for the expensive Ignite platform. So it gives not just us the ability to build more robust models, but it gives our clients a little bit of flexibility in the amount of data that they do have access to and sort of what we can do with that. So you think about just augmenting a smaller data file with similar borrowers, that proxy data set can give you a pretty good picture of what to expect from a risk perspective. Whereas if you only have 1,000 loans for the last year, you're not going to get a very good picture of what to expect going forward. And the standard scores and the default rate charts that are provided, I think typically they're not reflective of what you would experience, right? So if you go to, for example, FICO and you looked at their default odds charts, those are based on a development sample. The population that you work with is not the same. Things have shifted from that time zone, that time period. So really, this data can be used at any time in your process, creating models, adjusting, testing, but it's that whole credit file for the entire United States for consumers, and it has 5 years of history. So if you think about the power in that data, it really gives you that sandbox that I think all lenders have been looking for, and you can use our team to help come up with an appropriate file for you guys to build out a model.
Fantastic. Thank you, Nate.
I don't know, Carl, if you want to add anything to that.
Yeah, the other thing too is for us, it allows us to help insert your data into this environment, gives us access to 5 years of 100% of the bureau file to build more robust generic scores of where you're maybe limited to the number of bads. Allows us to bring, as Nathan mentioned, a way for you to build something more robust and predictive. And then I'm going to say the obvious part is the rich amount of data that the Equifax Ignite platform provides really helps open up that space. The other thing for those that have considerable modeling experience over time and are seeking a reject inference pool, that's an area too that we can step in to help enrich your future modeling efforts by enriching those that you've been saying no to. So reject inference is a big challenge. And that's it for me, Nick and Matt.
Fantastic, thank you. Picking up on you, speaking to the mute.
Matt, it sounds like you're in the distance there.
Oh, sorry about that. So yeah, as we kind of wrap up today's session, again, want to thank Carl and Nate for their insights. Again, really, hopefully the main takeaway that folks are walking away with is that we are driving growth for a multitude of lenders across various industries, as well as different customer segments. Again, just some of the top line figures you can see here, whether it's reduced losses, increasing your approval rates, improving just your overall operational efficiencies. We're confident that we can help drive value to your organization. And as a way to kind of put our money where our mouth is, we're offering an exclusive opportunity for our attendees today, where we'll enable you to test drive one of the offerings within GDS Link Modelica Analytics. Will allow you to test drive it for 90 days, whether it's our open banking attributes or the GDS Link credit attributes that we spoke to about earlier. Or if you want us to build a proof of concept model, we are confident that we can start providing immediate lift for your organization, and will allow you to again test run this data or these models for 90 days just to kind of see this growth in action. Carl, not sure if you had any other color you wanted to add around this exclusive offer for our attendees today.
No, it's I think it's a great way to get underneath or behind the curtain with GDS to see how we can provide value, and we're highly confident we can do so.
Again, in our follow-up today, we will provide a link where you can respond if you are looking to take advantage of this offer for your organization. It does not appear that we have any other questions. I will like to thank Nate and Carl for your time today. Thank you all again for your attendance this morning. And we hope that this was a valuable resource for you all. Feel free to reach out to Carl, Nate, or myself if you have any additional questions. Again, these slides and a video replay will be available later today at gdslink.com and our social media channels. Otherwise, on behalf of Nate and Carl, I just want to thank you again and hope everyone has a great morning.
Thank you, everybody, and thanks, Matt, for setting this up.
Yeah, thank you, everybody. Have a great day.